more minute and then go ahead and get started. And Davita, which market, where are you at?
I'm with West USA in the East Valley
East Valley. Okay. In Arizona?
in Arizona.
Okay. Amazing.
Where's everybody else from?
Colorado, Bridges in Arizona. Stephen, you live in Colorado too.
I'm in Colorado nowadays. They got me. I was in San Diego and then I moved out here for the new job in Denver. So,
And
Nice.
Davita, do you work with Kara?
I do.
Okay, amazing. She is an awesome loan officer out
Yeah.
in Arizona. I just joined her team. I'm like partnership. I'm in Colorado, she's in Arizona, and it's so fun to have just work with amazing professionals. So,
Yeah,
um,
she's awesome.
perfect. For time purposes, we'll just go ahead and get started. Um, thank you so much. And actually, let me. All right, we are recording. I just wanted to triple check that. Um, all right, it is just after 10 o'clock. Thank you so much for joining. We essentially are helping buyers get into homes differently, and that's what we're going to be talking about today. So, this is a $495,000 house in Houston, Texas. You've got a lakefront, you've got 2,900 square feet, but then you have little grandbabies, and they live in Colorado, and you live in Texas. And so a lot of our clients are wanting to move closer to their children, but also wanting to keep that I don't have a mortgage payment on my house. In our market here in Colorado, when you're moving to Denver and a $500,000 house gets you this little tiny 1,700 square feet, it's pretty cute inside, but it's really not that lakefront house that you were used to moving from. You can't entertain as well. You're not hosting Christmas and Thanksgiving. You don't have your guest bedrooms for when all your grandkids come in. And so that's why we want to talk about this idea of buying houses differently, because there is a way to get this larger home at maybe 900,000, putting your $500,000 cash and still not having a mortgage payment, but living that lifestyle in the later years in a way that makes more sense to you. For example, being closer to your children or your grandkids. So who am I? I'm Danielle Anderson. I'm a mortgage lender. Mortgage lender that primarily focuses on first-time home buyers, and I have brought in Stephen Barnes, who is a mortgage lender that primarily focuses, or totally focuses, on what's called reverse mortgages or flex mortgages. Our job is to provide clients options, right? So that they are very well educated to make the best decision for them. So there's first-time home buyers or like normal mortgages that you think of generally are what's called forward mortgages. That's what I specialize in. Stephen specializes in the reverse side, how to use that equity of your home and not have a monthly payment or even have your payment or even have your equity pay you a month so that you can live more comfortably when you're in your later years in life. So, when I'm talking about educating, one of my philosophies is that if I have a buyer that has a lot of equity that meets the thresholds of a reverse mortgage, is to present both options of like, hey, buyer, we can do a regular mortgage and this is what this is going to look like. Or, hey, buyer, we are going to do here's what a reverse mortgage looks like so that they are making the best decision for them and their family at that time. So, we're gonna uncover like the objectives of this call is we're gonna uncover reverse mortgage myths, how we can add value to your older buyers, recognizing who qualifies for a reverse mortgage opportunity. Talk about what is a reverse mortgage, the purchase contract, the loan process, and thinking outside of the box to help more buyers. And then any questions that you might have. So I'm going to turn this over to Steve Barnes, who really every day, day in and day out, goes through the helping clients with these types of mortgage is. So, Stephen, if you want to kind of just take it away.
Yep. So Bridget came on earlier and was saying that there's a lot of misconceptions about the reverse mortgage, and that's really where we want to start. I know that we have some agents on the call here with us, and it's important to understand that you can use the reverse mortgage to buy a home. And that's really going to be our primary focus today is helping to educate agents about this product so that they are in line to be able to sell more homes or help more households get into neighborhoods that they might have otherwise thought that they couldn't afford. But the initial feedback that you're going to get when you say the words reverse mortgage is going to be some pushback from the clients. They are under the impression that they don't own the house when you do a reverse mortgage, that you're going to be in the position where you could potentially lose the house. And there's a lot of misinformation out there on the web. So it's important when you have a client that qualifies that they're coming to Danielle, and Danielle can come to me if she's not yet comfortable explaining the product. Um, to help educate your clients so they're making informed decisions and finding themselves into a very sustainable home ownership option with this reverse mortgage. So right off the bat here, some things that we get all the time is that I would never do a reverse mortgage because I want to own my house. Well, a reverse is just a regular mortgage. And the bank doesn't own the house when you have a regular mortgage. Why would it be any different with a reverse mortgage? Your name is on title. You can close in a trust. With this product, there are options out there where you can start at the age of 55, depending on the state. The FHA product does start at the age of 62. But there are options out there where you can start at a younger age. You can't outlive your reverse mortgage. Technically, any guesses on what the loan term is on a reverse mortgage, Danielle?
I want to say it's like 60 years or something, like where they would
Getting
most likely
close.
pass away before.
Well, it would be 60 years if your client is 90 years old.
Okay.
Okay. So if you look at a title report and you ever see that a mortgage term is 75 years, that means that the client was 75 years old when they did the reverse mortgage because the loan term expires on the youngest borrower's 150th birthday. That's their way of saying that this loan is for life. As long as you live in the house, you pay your property taxes and insurance, then the loan terms stay in place. And those are that you're never responsible for making a mortgage payment. With that said, the bank can't kick you out of the house. And we hear it all the time in the reverse mortgage industry that, oh gosh, I'd never do a reverse mortgage. I think Bridget even had the example earlier. She said, "Hey, would you entertain the idea of a conversation on the reverse?" Eeks, I'd never do that. I've heard some terrible things about it. My neighbor lost her house when she did a reverse. The only way you can lose your home when you do a reverse mortgage is you don't pay the property taxes. So it's really not any different than if you own the house free and clear. You don't pay the county taxes. You're going to get a county tax lien, and if you don't pay them, then they're going to foreclose on the house. It's no different with the reverse or any other mortgage or home ownership situation. Kids nowadays are almost guaranteed to get money and inherit the house. We start very conservative. We'll talk about the loan to values and the calculations in a second. Banks not taking away the house after you pass away. The kids still inherit it the same way it would be with a regular mortgage. Okay. You're going to hear me say this about 15 more times throughout the course of the conversation. All a reverse mortgage is a regular loan, but with flexibility on your payments. So it's nothing to be afraid of. And really, what we do here day in and day out, as Danielle said, is just help educate our clients so that they're in the know as to how this works and making sustainable mortgage decisions in the long run. So if you want to jump to the next one, Danielle. So where we're going to add value, considering this product as a real estate professional, mortgage professional, is introducing this product to all clients that qualify. Even if you're not even if you feel that you don't need some flexibility in your retirement, it's helpful that you understand your options and that your clients understand their options. Old people know old people, right? And so educating those individuals on how this product works might come up in conversation for some of their other family members or other friends that could benefit from some flexibility. The reverse mortgage at its core, it's a regular loan with no mortgage payments. So right off the bat, that's a value add for your clients because they can get into this new home and not have the responsibility of a monthly principal and interest payment. Today's rates, Danielle, like where are we at on like a 30-year fixed rate?
Yeah, we're at about 6.5.
And with those higher rates, the payments are going up. So
Yes.
this is going to be an advantage to your clients that are looking to buy houses that they're not approaching this thinking, gosh, can I afford this in the long term? Because of course, with the reverse for purchase, you don't have a payment. You're accomplishing the same thing as the cash buy, no mortgage payment, but you're lowering your down payment. So on the reverse itself, I have a lot of clients saying that we're sitting on the sidelines waiting for rates to be fives. Well, on the reverse mortgage, guess what? We're in the mid fives compared to the 6.5 rate that Danielle's seeing on 30-year rates today. There's easier income and credit qualifications because, of course, we don't have that principal and interest payment. And then what that ultimately does for us is it gives us a chance to extend your clients' buying power, pushing them into neighborhoods, like Danielle said, that they might not think that they can afford today. They're retired, they're on fixed income, and they might think that in order to be able to afford this house, I have to pay cash for it. Well, there's an option out there where you have no mortgage payment and you don't have to pay cash for the house to push yourself into some of these other nicer neighborhoods closer to family. If you're moving from Texas, as she indicated, to Denver, you're not going to get the same price points as you are in Texas. Um, or same model for Phoenix, Davita. So this is giving the clients a chance to take back control of their retirement, really be in charge of their finances. And then, of course, the most sustainable homeownership option out there for retired folks. So if you want to jump to the next one again here.
Yeah, I'm just gonna pop in right here on like taking control of your retirement. I have a client that was a teacher, and unfortunately, her husband died of cancer. And so they had this big, beautiful house, and they still owed like 10 years left on their home. And she would have had to sell the home in order to keep that home as part of like after he passed away because she no longer was receiving his income and her income to make that work. And so stories like those are where this is a prime option of introducing this to clients. Stephen, I'll kind of walk through the product details, and it's not necessarily for everybody, but that's why I like to. I used to be like, oh my gosh, absolutely not. I will never talk about reverse. I think they're more expensive. Just think they're terrible. And then it was through conversations and education with Steven that I was like, oh my God, I'm doing such a disservice to my clients because I'm not giving them the full picture because it might fit perfectly into somebody's life where they've lived in this house for 20 years and they just can't afford it anymore on their own. Or somebody dies and they wanted to move closer to be able to babysit, at 4 p.m. and pick the kids up from the bus stop, and they thought that they were priced out of that market. So that's kind of my why on having Stephen come in and educate us. And I think that retirement years are totally different when you don't have one of the largest payments of our lives are our housing payment, and if we can not have one and live in retirement so differently, it starts flipping that script of what does life look like from 62 to 95 or 105.
Exactly.
May I
And
ask a question, Stephen?
go ahead.
Um, my name's Robert. I'm in Arizona as an LO. Don't know much about the reverse, but qualifying, you touched base on it briefly. Is it challenging for most folks? I have a lot of folks on fixed budgets, Social Security. How's qualifying work? And also at the same time, credit.
This is a good question. So ultimately, when it comes to qualifying, because we don't have that principal and interest payment, it's a heck of a lot easier to qualify for this product than any of the other mortgage options out there. The the largest household expense that we see when running regular pre-quals for clients on regular loans is going to wind up being that principal and interest payment. And so without that principal and interest payment, it makes qualifying much, much easier. And more often than not, even if clients do have W-2 employment, maybe they have some rental income, other income outside of their fixed sources like Social Security, we don't even want to hear about it when we're getting someone pre-qualified for a reverse because we don't need it. So it's very easy to qualify. There are no minimum FICO scores, so to speak, on a reverse. As a matter of fact, you don't even have to have a trade line in many cases to qualify for a reverse. Really, what we're looking at is going to wind up being, is someone responsible with paying their bills? Okay, you can have a 550 FICO score and reestablish good credit because you filed bankruptcy a couple years ago, whatever it is. And as long as you've reestablished good credit, you prove to the FHA that you are responsible paying your bills and that you are going to be responsible for paying taxes in the future, then you would be eligible. Um, Speaking of eligibility, so clients on the FHA product have to be 62 or older. In every state but Texas, you're allowed to have an older spouse as long as the older spouse is over the age of 62, married to a younger spouse, let's say 45, that household qualifies. And one of the negative connotations that come along with the reverse product is from the reverse of the past. And that's really important here is to understand that this reverse mortgage product is not the same as it was 15 years ago, let alone even 5 years ago. It's much different. And what was happening in the past is that this is an age-driven qualification. So the older you get, the more money you qualify for. And what was happening in the past 15 years ago is that you'd have that 70-year-old client married to the 60-year-old client, and the decision was made to structure the loan solely on the 70-year-old's age and remove the 60-year-old from the calculation. What was happening is that when the 70-year-old passes away, the loan's called due. And so the FHA looked at that. They said, you know what? That's a bad reputation. We don't want the reputation of kicking grandma out of her house when her husband passed away. So nowadays, both spouses must be on the loan so that both spouses have the protection to remain in the house the rest of their time, even if one of the spouses passes away. So borrowers have to be 62 or older to qualify. And then if they have a younger spouse, they're also protected, and we use the younger spouse's age. They're both going to remain on title. They both have to live in the house as their primary residence. And our biggest concern is, are they going to be responsible paying the property taxes and insurance and HOA if they have it? But taxes and insurance, as long as those are paid on time, you're in good standing. We're good to go. And then you'll see here in just a moment that the equity position that someone has to have is pretty substantial. And it's not necessarily something that hurts us with this product because, again, one of the biggest pushbacks that we've got over the years that mom and dad did a reverse mortgage, all the equity was eaten up, my inheritance is gone. Well, we'll show you here in just a few minutes that that's no longer the case. And there are our conservative approach with this is going to protect not only mom and dad if they are our borrowers, if they live and don't make payments on the house till the age of 90 and they need to relocate to assisted living, there's going to be plenty of equity left over for them to take with them to their new home, which of course benefits the estate. Okay. This is a protected age class we're working with, so everyone's got to go through a financial counseling call. Not only would they be educated by Danielle, someone like myself, but they would also have a second piece where they talk to an independent third party about the product, make sure that they're not being coerced or misled in any way, and making an informed decision. This is an FHA product, so house has to meet FHA standards, which usually means that if we have a condo that pops up in a purchase transaction, we'd probably consider the non-FHA option to make sure that we don't run into any issues when getting your purchase contract and meeting your contingency deadlines. So about the loan to values, if you want to shoot over to the next one. Um, in today's market, since 2017, they look at three different criteria. So it's the age of the youngest client, the house value, and then also today's interest rates come into the calculation. And to keep it real simple for everyone today, if you take the youngest client's age, say they're 70 years old, and you subtract 30, that's going to be about the starting loan to value for that household. So a 70-year-old client, Danielle, qualifies for about
40.
40%. An 80-year-old client, about 50,
50.
right? So when we're talking about a purchase transaction for all the agents on the call, if you're driving around showing them houses and you learn that they're 70 years old, you can know that they're going to make a down payment for about 60% on a reverse mortgage. And we'll talk a little bit about why that's not the scary figure that you might be thinking about right off the bat. A lot of the originators and the real estate agents that I work with, they're used to working with first-time home buyers, where getting 20% down might be a problem. A lot of those that are buying houses in today's market, they're either paying cash or they're financing quite a bit more to keep their loan payments down. Um, some quick data for you. So I think it's 42% of all buyers nationwide today are between the ages of 70, I'm sorry, between the ages of 60 and 75. Of that 42%, 50% are paying cash for the house. So this idea that this pushback that I get from loan originators saying, gosh, someone coming up with 60% down, that just doesn't happen. No, it's not your demographic, it's not your audience. There is a large majority of buyers out there that do have this 60% down that you're going to need on this reverse. So it's about one in four buyers qualifies for this reverse mortgage option, if not more.
I'm just going to put this into agent terms of like somebody wants to come and pay cash and buy a $400,000 loan or $400,000 home, right? In like settling of like, oh, it's like an hour away. Like I'm just thinking of our Denver market here of, okay, Denver, maybe you can find that $400,000 home in Brighton, but your kids really live in Littleton, right? So you are moving closer, but you're not moving that much. Like it's still going to be only weekends that you can see them versus picking up the kids from the school bus versus a $700,000 home in the area that they actually want to live, keeping them with the same goal of the 0% or the zero monthly payment. And then also from a overall how many clients you have to work with that year to make your same income goal, you've just now almost, 30%, you can have 30% less clients and make the same exact amount, which is why, not that we're selling this to just make more money, but I also want you to think about giving these options to your clients so they can make their own decision. Also helps you get into a higher price point bracket where then you're taking home more money working less.
So what the reverse itself is most commonly thought of as I'm going to get paid monthly. Absolutely can be structured that way, but that's usually when the house is free and clear. We also have it where we're actually refinancing an existing loan on the property, getting rid of the mortgage payment that they have. And then the most important factor that I want everyone to take with them today is how to use this to purchase. So we'll roll through these couple different scenarios here, educating you on how this all works. Next, please. So free and clear house, this would be the traditional mindset where you're going to get paid a monthly allowance or increase your income. At its core, whether it's going to be on a free and clear house, used as a refinance or used as a purchase, all it is a line of credit. The reverse mortgage is a line of credit, a home equity line of credit that doesn't require a monthly payment. So you notice that the current loan amount, this one that says reverse mortgage funds, we're going to use the same client's age through the next three scenarios. 70-year-old client, $600,000 property. The loan amount's not going to change. That doesn't change if it's a refinance or a purchase, always going to be about the same. Age less 30 will get you close enough today. So if this 70-year-old client has a $600,000 house free and clear, let's say that they have some other bills, maybe the roof needs to be replaced, the car's kind of going to be kicked to the curb here soon. They got some large expenses piling up. These clients are calling us saying, "Hey, what are my options?" Well, we have the figure line of credit option that's available to you. But also, let's lay another option on the table, the reverse mortgage. It's another line of credit option that you can qualify for that's not going to require a monthly payment. Whereas these other options, where we do a cash out loan or the line of credit, you're going to be responsible every single month to make a payment. So, house value appraises at 600, age less 30, they qualify for about 40%. That's that 245,000 figure. And that money's available to them as needed in the form of a line of credit. In this case, they're taking 75,000 out to buy a new car, new truck, whatever it is, and then the rest is available in money that they can tap into later. They're not paying interest on the full 245,000, just like a regular home equity line of credit. They're only paying interest on the amount that they actually receive or actually take out. Now, the remaining line of credit just sits there waiting for them. There's no expiration on that. As long as they're paying their taxes, living in the house, it stays in place. And it actually has a growth rate with it where it works and becomes a larger reserve for that client with time, indicated here by that yellow line on our graph. The 170,000 grows by about 6% per year so that clients have a larger amount of available equity to tap into as they age. So $170,000 growing by 6%, that's going to wind up growing by about $10,000 per year. So you have 170,000 after 1 year, now you got 180 after 2 years, you're going to have 190, 200 after four. So it's going to continue to become a much larger reserve for your clients that they can use as a strategy for retirement. And if and when it becomes time that they need access to more cash, let's say they two income household suddenly becomes a one income household. Now they need to supplement the loss of the Social Security income from the other spouse. They can say, I have that line of credit. I want $1,000 per month or $2,000 per month, whatever makes the most sense for them. They can structure it with our servicing department and start getting monthly payments from it. So there are options out there where this actually supplements income, and that's going to be predominantly when we're on a free and clear house like this. Now, when we're talking about the reverse as a refi, if you want to jump to the next one, Danielle, notice that the loan amount didn't change. Okay, it's 70-year-old client, $600,000 house, 245,000 is our total line of credit. In this case, they have a mortgage on the home. The mortgage is $200,000. Let's say their principal and interest payment is $1,500 per month. So the advantage to this household in this scenario is that we're going to use that 245, pay off the 200, and terms of the new arrangement are going to be that they don't have to make that $1,500 payment anymore. Cash flow benefits right off the bat by $1,500 a month, and then they're left over with whatever the difference is in a line of credit, in this case, 45,000. Can they set up the 45,000 on a monthly payment plan? Of course. But taking $1,000 out per month of 45,000, it's only going to last for 45 months, right? So there are different ways that this can be structured, and we talk to your clients about their goals, what's their 5-year plan, what's their 10-year plan to make sure that this is going to be structured in a way that makes the most sense for that household. Before we jump over to
Oh, sorry.
purchase,
Ah,
well, oh, oh.
quiet. Sorry. Ah. Okay.
Well, you can jump over to purchase, but I just want to pause there
Okay.
for a second, see if there are any questions.
Good
Nada?
question. So, max home value on this, is it the same for purchase or refi? And what is that?
It's another good question. So the maximum house value, so it depends on the products. But so there's two different types of reverse products out there. There's the FHA, which is going to be the $1,249,125 is the maximum house value on the FHA. And the clients qualify for a percentage of the $1,249,000. So if the house value starts to be in excess of the 1,249,000, that's when we may consider the proprietary. Some people often refer to it as the jumbo reverse mortgage, where let's say it's a $2 million property. Instead of being capped out at the 1,249,000 and getting only 40% of 1,249,000, now they're getting 40% of the 2 million when we're considering the jumbo product. So there are options out there for every household, up to technically $10 million is when it caps out. Believe it or not, I saw the highest appraisal I've ever seen a couple months ago. It was 18 million here in Cherry Creek. So they did a reverse, and then they bragged about it to all their neighbors, and then we did their neighbors reverse that appraised for 12 million. So it was a good little end to 2025 with those two for the loan originator. So jumping back to purchase, and it's going to work no different. Like we were saying before, it's just a line of credit, but that line of credit's being used to buy the house. So in many cases, people are going to be liquidating the full line of credit as a means to lower their down payment. Now, the scenario that we see most often, and I'm sure agents can attest to this as well, is that clients that don't have a mortgage payment on their existing house, they don't want a mortgage payment on their new house. So they're the ones coming to our agents out there. What I've been seeing is they're coming to the agents saying, I have a $700,000 house. I don't have a mortgage payment. I'm retired. I'm thinking about retirement maybe. And I don't want to add in a mortgage payment to my monthly finances. Well, if they sell that $700,000 house after settlement costs, they're going to net about 644, indicated in the top right corner there. And then they're coming to our agents and saying, "Hey, I don't want a mortgage payment, or maybe I'm not qualified to buy a house because I only get Social Security income." So they're limiting themselves to 600,000, coming to you saying, "I have $600,000 cash, I can go buy this house," which is of course pretty restrictive in the markets that I'm hearing we're involved in on the call. Denver, 600,000 is not getting you very far. Phoenix, definitely not getting you very far. So purchase price, yeah, they can pay cash if they find that house for 600, but they're committing almost the entire 644, and they're only left over with remaining cash of 34,000. Now, had they consulted with Danielle about the reverse mortgage, they would be able to buy that same $600,000 house where their down payment's only going to be 380. So this is a liquidity conversation for these clients. Does it make sense for you to commit all $600,000 that you're going to net into your house? Or is it going to be better for you to maybe do a reverse mortgage to buy where you're only committing 380, you have $260,000 left over so that we can s- confidently remain in the house and afford the bills associated with the home ownership. Uh, if you're buying a $600,000 house, there's a chance that it's a little older, that you might need some reserve to set aside for things like furnace, your roof, painting. I think that 264,000 is going to give them a more sustainable home ownership situation. Now,
I just did some quick calculations. So 264,000 divided by 30 years is $8,800 in they could use for 30 years, which is about 105,000 salary that they're no longer making. So when I'm putting this into terms of like, what does that look like? What does that look like? That could be the difference between taking an Italy vacation when you're 72 versus just having a house that you have no monthly payment on, right? That might be going to take those flights to visit grandkids. And so I feel like putting those into stories is helpful to understand why somebody might want this. Making $100,000 when they're actually only making 2,000, 2,500 in Social Security is completely life changing for those last 30 years of their life.
absolutely.
And that
And
doesn't even
remember,
include any growth on that money, right? What they could be
Correct.
earning. And
Yeah, and they don't have to use any of it, right? But if they needed to, it's like, oh, I want to take this money out to go do X, Y, or Z. Whoops, I don't know why I keep jumping ahead. It's like every time I click, even if it's on the other side, it goes to the wrong place. So yeah, it's not even including growth.
hey, Steven, I had a quick question. If I know no payment is ever required, but would it ever make sense to make a payment? And what, can they do that or do people do that?
absolutely. And so that's why internally we've started to rebrand this as the flex pay mortgage because the clients have complete control over whether or not they make a payment. And I like to ask the clients this question, and I say, when you were younger, did you put aside money for your daughter's wedding, or did you put aside money for your kids' tuition? Most households that I speak to, they put aside what they could afford at the end of every month in an account that was designated to be a rainy day fund or for my daughter's wedding for tuition. Okay. It's never a rigid $1,000 per month. It was always what could I afford after paying all my other bills. On the reverse mortgage, it's taking back that control because the house is usually going to be what the kids inherit. And instead of paying a rigid $2,000 a month with a regular mortgage, the clients can approach this now when they do a reverse mortgage and say, I paid all my bills. I only have $500 left over this month. Or I paid all my bills. I don't have any cash left over this month. And that's going to dictate whether or not it makes sense for them to make a payment. Now, if the kids don't visit during the holidays or they didn't make a phone call to mom and dad for their birthday, maybe they skip a payment because they're a little worried about whether they're not as worried about whether or not the kids are going to inherit the house. So, it's a mortgage option that allows you the flexibility to control your own payment is what this is. Now, I like to break it down for clients as to what does it look like on a monthly mortgage statement. So I know, follow me on the math here real quick, but it's let's just say it's $100,000 loan amount, just for sake of conversation, and interest rates are 6% to keep the math simple. So that's $6,000 a year in interest on a $100,000 loan. So if you have monthly mortgage statements coming out and you have a $100,000 balance, your statement's going to say your balance is 100,000, and just beneath it, it's going to say there's $500 accumulating in interest this month. Instead of the bank requiring you to pay 800 or $1,000, now the decision's up to you. And you make the decision based upon what's left over. I look at my statement. I see that there's $500 in interest this month. If you choose not to make a payment, fine. The balance is going to grow, by $500 every month. Now, if you make a payment for $500, the balance is going to stay at $100,000 because you've taken care of the interest that month. If you make a payment for $800, well, guess what? Now you're treating your reverse mortgage exactly like a regular loan. The first $500 goes to interest. The extra 300 is going to pay down your balance by $300. So it's completely up to you whether or not to make payments. And if you do make payments, that's going to dictate how quickly your loan balance goes up or goes down. Now, the most intriguing part about this here, Danielle, if you can go to the next slide, is this same client that sold their house for 700,000 that's coming to our agents thinking that they can only afford a $600,000 house if they don't want a payment. Oh, well, the downside.
Wait,
We're
is
so
this what you were getting at?
this is
Upgrading?
where I'm getting at here. So
Okay.
same client, net proceeds 644,000. They can buy a $1 million property with the reverse mortgage and only have a down payment of 620,000. So they're relocating from Texas to Phoenix, looking at houses. They can't afford anything at that cash price point. Well, if you're 70 years old, let's have a consultation with them to talk about how this works. Because we might be able to get that client that sold their house in Texas for 450,000 into an $900,000 property in the Phoenix market. So this $1 million purchase, they qualify for the same 40% about that was getting you close enough. You can see in this case it's 38%. Their down payment 620,000. They get into that $1 million property instead of the 600 one that they thought they could afford. And they have the benefit of the cash buy, which is no more monthly mortgage payment. This is where I think the agents are missing the opportunity, personally. It is just not thinking outside the box a little bit that when I have a 70-year-old client, let's send it over to Guild, even if they have cash. I know it's sacrilegious to take a cash buyer and try to move the financing, but it's going to increase your purchasing power.
And I think the questions as an agent is what is the type of home that gets like that meets all of your needs, right? Are we looking for a 4 bedroom? What is that area? Pulling up a listing of those types of homes that meet those needs. And a lot of times those types of homes that meet those needs that also have I'm paying cash don't coincide. Right. And so that's the first conversation of like, what is it that we are trying to achieve and get to from a property standpoint? What area? Uh, Now we know we want a $0 payment and we know we want, and they're paying cash. But when we look at the houses in that area, they don't actually meet the needs of the client. And at that point, that's a conversation that just says, hey, Tom, I know that you really want to live in Wash Park, Denver. And Wash Park, Denver, average purchase price, and I'm making up numbers right now, is 1.2 million. You have $800,000 that you said your budget was, but $800,000 really gets you a townhome and not that single family home with that backyard that you'd like. There is a way where we can get you that $1.2 million house where you still don't have a $0, where you still have a $0 monthly payment. Are you open to a conversation of a consultation just so that you can understand what that looks like? That's the language that my agents are using to at least have that conversation because my whole philosophy is without education is inaction, right? When clients don't understand and they're not clear on something, that moves them to not make decisions. If they come to you with an $800,000 purchase price, but then they can't find what they need, they might stay in Texas, right? Because they no longer can meet the needs of why they would be moving in the first place, which is essentially to get closer to their children. So I never want to push a client into a mortgage that they do not need. Both my parents have homes that are paid free and clear. However, if my dad ever passed away, like we at least know that there's an option to keep that to keep that house. So I guess that's my I'm off my soapbox, but creating options, people don't know what they don't know until they have a conversation. And opening that door to a conversation is, I think, what our job is as industry professionals, so that clients are very educated in all of the decisions and options that they have available to them.
Absolutely.
Yeah, I think
Okay.
this slide really is important in the Arizona market because it's gotten so expensive here, and this is a great solution to getting in the neighborhood you really want to be in. So I like that there. One question on the purchase. Go right back to FHA guidelines. Can the seller contribute towards closing costs on these?
6%. Yep.
Okay,
Up
great.
to 6%. And that is one of the big pushbacks that we get on the reverse mortgage. It's an FHA loan, and just like any other government product, the government's got to get paid too. So the closing fees do tend to be a little bit higher with this. But of course, the clients are getting extra protection with the government mortgage insurance that's required on these products. But in the purchase scenario, we see all the time. Like I just we had an agent go back the other day to negotiate about $20,000 worth of seller concessions after the appraisal came in low on a purchase. And that took care of the lower appraisal and some. So absolutely something, especially in this market, that you can probably get away with. All right. So next
I just
slide.
had a quick comment on that. I think, or that, and on Danielle's comments, that I think I think there are a lot of people that don't realize they could buy with this product, and I think it's just, it's just another tool in Danielle's toolbox to help her folks. But I mean, I would think, with you're talking about so many people that are still making a mortgage payment in retirement and don't even realize they might be able to sell and move closer to their kids or grandkids or something like that. I think, you know I hear a lot like, oh, I'm I feel locked into my 3% mortgage or something because one, they had to qualify when they got in there and they don't even know that this is an option, where I think, and as a realtor, I'm thinking now the gears are grinding like, hey, you may be able to get a listing and a sale out of this, if people are, so I'm glad you're doing this. Like the gears are grinding here.
Yeah, I agree with that, Tom, because as you learn more about it, I mean, we're all consumers and the money's not lasting as long. So if we can eliminate a mortgage payment, that's going to really change some things for some folks that are on even a pension and a Social Security income. It's mind blowing when you go to the gas station and the grocery store and then throw some insurance on top of that. You're like, how's it going to work for anyone at this point? But this is great.
I just got a new truck with a 35-gallon gas tank, and boy, is that I haven't made my first trip to the to the gas station yet, but I'm not looking forward to it. Um, so real quick, I know there's a lot of numbers on this slide. I do want to get into the different creative ways in a second that to maybe get those wheels turning even more than I see that they are right now. But this slide in particular, not looking at the whole thing, right there in the middle, the loan balance. So that $1 million purchase that we were talking about, loan balance starts at 409, and you can see home value just to the right's $1 million. Okay. And this client started at the age of 70 and they don't make payments for 10 years. So 10 years down the road, loan balance is going to about double if they're not making payments. Now remember, clients can always choose to make a payment if it makes sense for their finances or if they want to preserve some additional equity for the estate. But really, important here is that you understand that 10 years down the road, the house is worth 1.48 if we're following just an average of 4% property appreciation. Now, that's the nationwide average since they started keeping track of it back in the late 1980s. And so, as long as we're averaging out at 4% property appreciation, kids inherit the house for 1.4, 1.48 in this case. They usually list and sell it, pay off the 791, and what's left over is in the far right column, the 688. So the the starting point being 40% loan to value nowadays is making sure that if dad lives to be 85 years old and he hasn't been making payments for the last 15 years, is there going to be money left over when he has to move to assisted living? Well, in this case, you can see that there is. Who benefits? The estate. So that pushback that we get saying, "Oh, I would never do it. I want my kids to inherit the house." Well, let's take a look at it because it's not the way that it used to be. So it's really designed to make sure that there's equity left over.
Quick
Go ahead.
question on that. Oh, I'm sorry, Daniel. Go ahead, Daniel.
Oh, I just have a comment on that. One of my key takeaways when the first time that Steven and I met was um, that kids are helping mom and dad while mom and dad are still alive. Right? I literally just had a jumbo loan that we had to get a letter of explanation because the son is helping their 85-year-old mom and he's paying her $1,000 a month to help sustain her living. Right. And so that was my mindset shift of like, oh my God, I've had multiple clients say, oh, I want to buy a house for mom because they can't afford it. And they like, so now we're flipping the script versus instead of me at 30, 38 years old, helping my mom and dad make their payments because they're both retired teachers, they're just using their own equity that they've lived up to. I'm a successful 38-year-old. I don't need mom and dad's inheritance. I would much rather them go to the beach house with me and my family and my nieces and nephews while they're alive, right? Versus not tapping into that. So that was my mental shift when we started talking. It was like, holy crap, you're totally right. People are helping, like my parents, I think, helped pay for assisted living for my grandma and grandpa when really the house could have done some of it. So anyway, that was my other shift of thinking of like, yeah, people that are in their late 30s, mid 40s are helping support mom and dad when mom and dad's house could actually be supporting them.
Absolutely.
Go ahead, Tom.
But I'd say also you know, they're going 15 years without a mortgage payment on $1 million home. They just gives them some options. They can create some memories with those kids and grandkids. And I've heard the term giving while living, so I think it gives them a lot more options that in this.
Which is actually a great segue, Tom, to our next slide here. Well, actually, next slide, but let's talk about this real quick. So the
Oh, go
process,
back.
go back.
Ah!
So the
Well, real
process
quick,
was,
when you're getting to that, Steve, quick question, because you mentioned that 10 years of your equity position on that last slide you covered. And you said more than likely the family will sell the house. What are their options when the reverse mortgage holder passes?
so they're no different than a regular mortgage. And I want you all to remember this. Like you already have the answers. You just don't know that you have the answers. When in doubt, default to what you know about a regular loan because the answers are almost always the same on a reverse mortgage. When mom and dad pass away and have a reverse mortgage on their house, kids have two options. Are we going to keep the house or are we going to sell the house? Okay. No different than if there's a mortgage owed against the property. Most people think that mortgages are assumable. They're not, right? So like if there's no longer a social security number that the servicer can report the payment history to, they're going to start asking questions. Kids might be able to get away with making payments for some time, but at one point or another, they're going to be required to refinance that note if they care to keep the property. Same comes up with the reverse mortgage. They have 6 months from the date of the last surviving spouse's expiration to decide, are we going to keep it? Or are we going to sell it? And then they have up to an additional 6 months. So it totals 1 year for them to actually execute the sale or execute the refinance or paying back that loan in some capacity within a year. After a year, then there'd be more questions, but they'd have a year to actually execute selling or refinancing. And as you can see, there's going to be plenty of equity left over for them to divvy up.
So,
Process, no
but
different than a regular loan. Okay. And I'm going to jump through this because I want to get to the next slide here, Tom. The 30 days from start to finish is our usual close of escrow on refis. Purchases can be taken care of much quicker. So I prefer to see a 30-day close of escrow, but if you need 3 weeks, we can actually absolutely entertain that. Um,
I'm just gonna jump in here for the agents watching this is like for me, I'm always your point of contact for if you have a client, let me know. We'll go through both options of forward options and reverse options. If a reverse makes sense for your client, then I hop Steven in because Steven is the reverse mortgage specialist that does reverses every day, all day. As you can see, there's a lot of intricacies that aren't on a regular loan. I don't want to be good at everything. I would love to be good at what I'm good at, which is forward mortgages, and Steven is good at what he's good at, which is reverse mortgages, so that you have two experts on depending on which option that they want to go. So that initial introduction, you can just reach out to me, then I will get them set up on a consult with Steven for the reverse side of things. But it's no different from either way from an agent standpoint. There's no different on how you write your contract, how you do anything on a contract level side of things. It's still just an FHA purchase
with 60% down.
with 60% down. Yeah. Yep.
Right. So a lot of agents like, oh God, FHA, why I don't want to put that into a contract. It's an FHA that's a pretty attractive offer with 60% down.
Yeah.
So next slide here. I know we're up on time, but I do want to hit a couple of points here, especially DaVita being in Phoenix. I think that there's some really important things that you can take from this. So clients moving from lower cost states to higher cost states, we've beat that already. But fixed income self-employment clients struggling to qualify for other loans, this is their option. Divorce, Amber Alert. Divorce, silver divorce. This comes up all the time where we can actually do cash out of the loan of the home if one party wants to stay in the house, getting cash out so that you can take the other divorced spouse shopping. Um, Maybe doing a reverse for purchase on that house to get their price point up a little bit. Uh, this for the loan originators is huge. And then also the real estate agents need to be thinking about that. Parents and grandparents taking money out of their home to gift down payments for our first-time home buyers. The one thing that we run into most often in the mortgage industry is first-time home buyers not having that 20% or not having enough to get their payment down to where they want to. They're shopping for houses at 700,000, but they're only pre-qualified for four or five. Well, asking follow-up questions. Do your grandparents own a house? Do your grandparents have a mortgage? Would your grandparents help you out if it wasn't going to impact them month to month? Bringing that inheritance forward, as Tom mentioned. Now you're getting them into that price point that they wanted to be pre-qualified for. Now, the point that I wanted to make to DaVita here is the snowbirds coming down to Phoenix. Okay. People having their house up in Minnesota and it's free and clear, and they want to buy a house down in Phoenix with you or wherever you're at. Well, they can do a reverse mortgage on their primary residence in Minnesota so that they can get the down payment that they need for the house in Arizona. Okay. That let's say that they take 200,000 out of the house in Minnesota, there's no mortgage payment with it. So that's going to drastically increase their opportunity for buying that second house with you down there. So hopefully this was educational for everyone. I want to be respectful of everyone's time, but if I know I can stick around for a few minutes if you have additional questions. You can always reach out to Danielle, to myself, and we can address questions after the fact or any point in the future. One last little thing I'll leave you with here is that when you're driving around showing clients houses, don't say, "Hey, do you want to talk to Danielle about a reverse mortgage?" Because they're going to say no, right? They're gonna be like, "Gosh, that's the terrible product." They didn't get to sit through this education like you did today. So just keep it real open-ended. Be like, there might be options out there worth considering. Do me a favor and have a consultation with Danielle. She'll review all your options, and then we'll figure out what the best solution is for you.
I absolutely love that advice. And I love that advice for reverse or for regular purchases. For whatever reason, we are very scary as lenders and nobody wants to talk to us. But if you position it in a different way of like, hey, let's just see what your options are, it becomes a different conversation when you have that with clients. So thank you so much for being here. If you have any questions regarding real estate, I know that Guild does loans in 49 states, just not New York. My team and I can do 49. I'm personally licensed in 9 states. And we're here to answer any questions regarding real estate and financing. So thank you very much. And if anybody wants to stay on and ask any other questions, Stephen and I will stay on for about 5 to 10 minutes. But have a great day.
All righty. Well, thank you again.
Thank you, Danielle. Thanks, Stephen. Great presentation. If I have any questions, I'll reach out. Danielle, should I reach out to you or to
Kara is your girl in
Okay.
Arizona. She'll know way more about Arizona stuff. And then uh, Kara can loop in. Stephen, are you in Arizona too?
Stephen, are you Arizona?
So I manage an entire team of folks that actually we have another individual in Arizona to help Kara out, but she can absolutely do the same thing that Danielle can with this reverse product.
Okay.
Yeah.
Terrific.
So I would say connect your clients with Kara, and then Kara will have the information to be like, okay, this is your option on a forward mortgage. This is your option on a reverse mortgage. So that way the clients are making that decision of what's best for them.
Gotcha. And would they work with Kara through the whole thing, or would they be working hand in hand with someone like Stephen in Arizona?
So we would partner up together. So the
Okay.
client, it's Danielle, like Kara's
It's
client or Danielle's client, and then
Yeah.
I'm just there to keep it in the lanes. I'm the bumpers in the bowling alley, basically.
Yeah.
So
Um,
essentially how it works so like I'll share with you my process. So if you sent Kara a lead, Kara's going to pick up the phone and call that client and do a 15-minute initial consult over the phone, getting what are their goals, what area do they want, what purchase price are they looking at, oh, they think they're going to pay cash, or they have X amount down. She identifies, oh, they're of the age of 62, so they would qualify for either option. They have a large down payment, which is also a trigger for us as loan officers of, yep, like time to loop in the reverse mortgage specialist of making sure that they're presented both options. Then at that point, I'm going to schedule a 30-minute Zoom consult with clients to review. Here's option A, here's option B, here's like reverse, here's forward. Typically, I'm going to invite in a reverse mortgage specialist like Steven to be on that consult with me, where he's prepped his reverse information. I've prepped my other information so that just kind of like going through this slide with the client, we're going, okay, we can do, all cash purchase of 600. You can do the reverse, or you can get $1 million and like side by side. So that way, when we send them back out shopping with you, we know how to qualify them. Are we qualifying them at the $1 million loan? Because they don't actually qualify for the $1 million loan if we're not doing a reverse. We're only qualifying them for X, Y, like what they qualify for originally to give you more options as the agent to best align that with your client. So from that consult meeting, my objective of that consult meeting is like, does the client want reverse or does the client want regular mortgage? And then that way you have your price point to shop within.
Got it. Okay. Thank you. That's super helpful. All right. You guys have a great day. Thank you.
you too.
Awesome.
Thanks for
Thanks, Avita.
Hey.